Good morning, friends. In this video, we will go through the concepts surrounding the redemption of debentures. I believe you're all aware of the concepts around the issue of debentures. So we will not focus on the issue of debentures, but in this chapter, we will go through the concepts around the redemption of debentures. So what is redemption? Redemption means repayment. Okay, right. Now, if you look at the types of debentures, just an overview, right? You can classify debentures based on security, convertibility, permanence, negotiability, and priority. Now, when I talk about security, debentures can be of two types. One is secured debentures, other is unsecured debentures. When I talk about convertibility, debentures can be convertible debentures or it could be non-convertible debentures. So when I say convertible, they are convertible into a equity share capital, right? When I say non-convertible, they are not convertible. Permanence, they are redeemable debentures as well as irredeemable debentures. Redeemable means you have to repay it back. Negotiability, they are called registered debentures as well as bearer debentures, which means you do not bear your name. Priority, first debentures and second debentures. So this will happen during the liquidation of a company as to which debenture holder should be paid first. So those who are holding the first debentures will get paid first, and the second debentures will be paid the next. Right. Now, as regards the methods of redemption of debentures, there are typically four methods. One, straight away in lump sum you can pay. For example, you have issued debentures worth 5 lakhs. Well, let's take the duration is 5 years. At the end of 5 years, you just repay that 5 lakhs lump sum payment. Or you may decide to pay in installments, 1 lakh each for 5 years. 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh. You can pay 1 lakh every year, right? That in installments. That is one thing. The third one is very, very important, by purchase in the open market. What generally happens here is that your own debentures are trading in the market at a discount. So you actually pay a lesser price in the market and you try to cancel the debentures which have already issued to debenture holders. For example, you have issued one debenture face value of 100 and you see that your debentures are trading in the market at 97. So what do? You go to the market, pay rupees 97 for the debenture, and which means by essentially paying 97 for the debenture, you cancel the 100 debenture. So you purchase your own debentures at 97 by paying 97, and once you purchase your debenture, you cancel the liability, right? That is something which is very, very interesting. So that you get a chance to redeem the debentures at a discount. So when you issue debentures for the first time, right? So you can actually give a promise to redeem at par or premium, but at the time of issue of debentures, you cannot say that I will receive 100 from you and I'll repay 95 to you. That is not possible. Nobody will agree to that. So that's a reason during the issue of debenture stage, you will have an entry for redemption at par or premium, but you will not find an entry for redeeming at a discount. But there is a possibility of you redeeming at a discount when you actually purchase your own debentures in the open market, because they are trading cheap. So you go to the market, buy your own debentures, purchase your own debentures at a fairly lesser price. So let's take 100 as the face value, but if it is getting traded at 97, you pay 97 in the market, you purchase your own debentures, and then you try to cancel the liability. So there is a profit on cancellation as well. And the fourth method is the conversion of debentures. So you can redeem debentures by converting them into equity shares also, right? So that is also there. So how do you do that? You debit debentures and credit the equity share capital. But very important, when you convert the debenture, you need to determine the number of shares you're going to issue at what price. So that small calculation is required there. All right. Now let's look at the provisions of the Companies Act 2013 regarding the issue of debentures. Even though we are talking about redemption, there are a couple of points when you issue debentures. It has got a direct implication on the redemption part also. So what they say, section 71, subsection 2 and 2, subsection 1, 2 and 4. Let's talk about section 71.1. A company may issue debentures with an option to convert such debentures into shares either wholly or partly at the time of redemption, provided that the issue of debentures with an option to convert such debentures into shares wholly or partly should be approved by a special resolution passed at a duly convened general meeting. So this directly has a connection with the redemption of debentures by means of conversion. So you have to pass a special resolution, right, at a duly convened general meeting, right? Now, 71.2, it says no company can issue debentures which carry any voting rights. That's important. 71.4 is very critical. They say where debentures are issued by a company, then the company should create a debenture redemption reserve, DRR, out of the profits of the company available for the payment of the dividend, and the amount credited to such account should not be utilized by the company for any purpose other than the redemption of debentures. So, for example, for redeeming preference shares, we created something called CRR, Capital Redemption Reserve. Similarly, before you redeem the debenture holders, and if you're going to make use of the free reserves and profits, then you need to transfer an amount to an account called Debenture Redemption Reserve Account, DRR account. So DRR is mandatory. That's one thing. So how much DRR to create, that depends upon the nature of the organization. We will see a little later. So DRR needs to be created. Now, not only DRR, you have something called DRR, right? I to be created. But before that, let's look at the DRR percentages, how much we need to create, who are required to create DRR and who are not required to create DRR. Thereafter, we look at DRI. Look at this. Debentures issued by all India financial institutions regulated by RBI and banking companies for both public as well as privately placed debentures, no DRR is required because they are cash rich. If something is governed by RBI, then so banking companies, so you will not have any problem in terms of liquidation or cash flow, right? So there is no problem of creating a DRR, right? Similarly, other financial institutions within the meaning of clause 72 of section 2 of the Companies Act, DRR will be as applicable to NBFCs registered with RBI as per 3 below. We will see what is the 3. For listed companies other than the all India financial institutions and banking companies above, all listed NBVs registered with the RBI under 45(1)(a) of the RBI Act and listed housing finance companies, HFCs, housing finance companies registered with the National Housing Bank for both public as well as privately placed debentures, again no DRR is required. Other listed companies for both public as well as privately placed debentures and no DRR is required. Now, so these are all for listed companies. If you look at for unlisted companies other than the all India financial institutions and banking companies and all unlisted NBFCs, again no DRR is required. If you look at the last category, this is where it's important. The other unlisted companies, the DRR shall be 10% of the value of the outstanding debentures issued. Right? So DRR essentially is required for unlisted companies, right? And those unlisted companies which are actually not registered with RBI. So even if you are an unlisted company or an NBFC who are registered with the RBI under 45(1)(a) of the RBI Act and unlisted housing finance companies, you don't have a problem. But for other unlisted companies, right, which means when I say other who are not registered with the RBI or other housing finance companies, then you need to create a DRR to the extent of 10% of the value of the outstanding debentures issued. This percentage is very important. So how do we remember this? Look at this. No DRR, no DRR, no DRR, no DRR. So DRR is required only for certain companies, right? For all India financial institutions which are governed by RBI and banking companies, no DRR. Other financial institutions within the meaning of clause 72 of section 2 of the Companies Act 2013, which is typically the DRR will be as applicable to NBFCs registered with RBI as per clause 3 above, clause 3 below. Okay, so very important that you need to create a 10% DRR for those companies which are not governed by or not registered with the RBI. That is very important. Okay. Now it's not only the DRR, you also have the DRI also. You have to make an investment. So all listed NBFCs, all listed housing finance companies, all other listed companies other than all India financial institutions, banking companies, and other financial and other FIs, and all unlisted companies which are not NBFCs and HFCs, they shall on or before the 30th day of April in each year, in respect of debentures issued, deposit or invest a sum which should not be less than 15% of the amount of its debentures maturing during the year, ending on the 31st day of March of the next year in specified instruments or investments. So you need to create a DRI to the extent of 15% of the amount of debentures to be redeemed. right? And this DRI should be done on or before the 30th day of April. 30th of April is the timeline. So let's take, for example, if you're going to redeem somewhere a debenture in, let's take February 2021. February 2021. So let's take 1 lakh. 1 lakh is due for redemption on February 2021. You need to create a DRRI to the extent of 15,000 on or before 30th April 2020. That is the meaning of this. So I repeat, you're going to redeem a debenture worth 1 lakh on somewhere in February 2021, which means on or before 30th of April 2020, you need to create a DRRI to the extent of 15% of that 1 lakh, which is 15,000. Okay, so that is very important. Now, once you've done that, so you're creating a DRR and then you're creating a DRRI. Now, let's look at the accounting entries. Now, if you're going to create a DRR, right, to the extent of 10%, what is the amount, what is the entry we have to pass? P&L account debit to debenture redemption reserve account, because this is set aside from the profits. So we'll debit P&L account and credit the DRR account. Okay, and then as I said earlier, we need to make an investment as well. So DRRI to bank, it's an asset, right? So debenture redemption reserve investment account debit to bank. Now, once you make an investment, you will receive interest on that. So we'll say bank account debit to interest on DRRI. You receive the interest, and this DRRI interest is taken to P&L account. That is very important because this is not getting reinvested elsewhere. So we will take it to the P&L account and we will not take it to the DRR account, which is very, very, very important because we are not going to essentially reinvest this interest. So whatever interest we receive from the DRRI, we will take it to the P&L account. If we reinvest, then it's a different story. But we are not going to reinvest, so we will take it to the P&L account. That is very important. Now, during the last stage, when you're going to redeem the debentures, for example, you need to first liquidate the investment. Am I right? So bank account debit to DRRI. That is the first step. And once you've done that, you need to repay the debenture holders. So debenture to debenture holders and then debenture holders to bank. Straight away, you just transfer the amount payable to debenture holders and then we say debenture holders to bank. Once the purpose for which the DRR is set, it has been achieved. Because the DRR was first created to redeem debentures. Now that you have redeemed the debentures, whatever balance is available in the DRR, it's not required. We need to transfer it back to the general reserve. So we will say DRR account debit to general reserve. The last entry is very important. Many people, many students will leave the balance in the DRR. It's of no use because the purpose for which the DRR was established is fully accomplished. So you need to cancel it. You need to transfer it back to the general reserve. So DRR to general reserve. So there are three important concepts, friends. One is the requirement of DRR, other is the requirement of DRRI, and then finally the accounting entries. So DRR, so most of the companies, they don't require, but there are some unlisted companies which are required to create a 10% DRR of the outstanding balance of debentures. That's one. Then you need to create a DRRI to the extent of 15% of the debentures to be redeemed. So as I told earlier, February 2021, if you decide to redeem 1 lakh worth of debentures on or before 30th April 2020, you need to create a DRRI to the extent of 15,000. That is important. And then pass all the entries in the same fashion. The interest, the most important thing is the interest on DRRI is not taken to the DRR account. Instead, it's taken to the P&L account. The logic being we are not going to reinvest the interest. So it's a complete gain. We'll take it to P&L. And once the debentures have been redeemed, whatever balance is remaining in the DRR account, we will actually transfer it to the general reserve account because it is from there. Because we took it from there, and now the purpose is achieved. We will transfer it back to the general reserve account, right? And then the last concept is on the conversion of debentures into equity. Fairly simple. So, for example, if there are 100 debenture holders, and if the maximum conversion is 20%, right, which means 20 debenture holders agree for conversion, right? There is going to be a conversion price, right? At what price are they going to convert, right? Because the other 80 debenture holders who they do not agree for the conversion, you have to pay cash for them. But for those debenture holders who agree for the conversion to equity, there is going to be a conversion price for them. So we have to determine the number of equity shares to be issued based on the conversion price. Right. So nothing to worry on this. So we will be solving a lot of problems on the debentures on these 3 or 4 models. So the 4 types of redemption, they are by lump sum, by drawing of lots or in installments. Number 2. Number 3 is purchasing in the open market. This is exactly where you can redeem the debentures at a discount, right? And fourth one, by converting the debentures into equity. Okay, so these are the basic concepts surrounding the redemption of debentures. And now once we start solving the problems, you will gain more clarity on the concepts. That's the end of the video. Thank you.